Hey everyone, I recently participated in the Western CREF conference hosted by the California Mortgage Bankers Association. At the event, I spoke with a variety of lenders about what they're seeing in the debt market. And in general, the lenders were cautiously optimistic about the commercial real estate outlook. Three key trends emerged from the conversations. The lenders indicated that debt capital liquidity remains good for most property types in most markets. They believe there's downward pressure on fixed mortgage interest rates, both in terms of the underlying basis, generally the 10-year Treasury, and in terms of the lender spreads. And while several mentioned that credit restrictions have loosened a bit, their loan-to-value and debt service coverage ratios have generally remained static thus far. So I wouldn't characterize the debt markets as free-flowing. There's still some caution out there. But in general, the debt capital availability remains good. Banks and credit unions are trying to increase their lending volume a bit, but they remain cautious. Many are still trying to reduce their overall commercial real estate exposure, especially to office properties. And they're very cognizant of regulator oversight right now. As for CMBS, market conditions are strong, with CMBS bond investors showing a healthy appetite for lending, especially for hospitality transactions. Life companies also remain active, focusing on low leverage deals with strong sponsors, while they also try to reduce their exposure to office assets. On a broader basis, a key ingredient in the lending climate has been the 10-year Treasury, which peaked near 5% in October last year. As signs of a Fed rate cut increased at the tail end of 2023, the 10-year declined to about 3.9%. Then, when the Federal Reserve pulled back on their rate reduction language in early 2024, the 10-year climbed back up to the 4.6% range. Since then, signals of an impending Fed rate reduction have once again strengthened, hopefully culminating in a cut this Wednesday. And the 10-year has fallen back under 3.7% in anticipation of this. With Wall Street heavily leaning toward the Fed reducing rates by 100 basis points or more by the end of this year, the downward pressure on interest rates is significant. But the next Fed rate decision after September 18th will be on November 7th, 2 days after the election, and the next after that is on December 18th. We need to remember that additional rate reductions after September are not a foregone conclusion, regardless of how Wall Street's betting. As I've mentioned in the past, while the Federal Reserve has claimed to be blind to election results, suggesting they'll follow their mandate regardless of who wins the presidency or the legislature, their caution levels would likely escalate if the election is contested. And if the results are contested as strongly as they were following the 2020 election, the Fed could put rate cuts on hold until clarity emerges. So for now, based on the expectation of a cut on September 18th and the belief that additional cuts will follow, the 10-year Treasury and lending rates are down. Current apartment rates on agency-backed 10-year loans are running in the 5.25% to 5.75% range. Retail debt is running in the 5.5% to 6.25% range. Office loans, which are possible but extremely difficult to get, are running between 6.25% and 7.25%, while industrial properties are being funded in the 5.25% to 6% range. Self-storage lending is running between 6 and 6.5%, and hospitality loans are running between 5.75% and 6.75%. Of course, those rates could move substantively based on how the 10-year Treasury and other metrics move in the coming weeks. In addition, there's substantial variance on rates depending on the asset quality, where it's located, the borrower's strength, and a variety of other factors. But in a nutshell, considering the uncertainty surrounding the upcoming elections, I believe now is the time for investors to take action. Interest rates have come down and cap rates are still elevated. The Mortgage Bankers Association recently released a forecast of lending activity suggesting that lender volume would be up by about 25% in 2024 compared to 2023. Considering that commercial real estate sales volume for the first half of 2024 was down a bit compared to the first half of 2023, The MBA estimate suggests the second half of 2024 will be much more active than we've been seeing over the last 18 months. So investors, both buyers and sellers, may be working with a relatively narrow window where cap rates and interest rates align to clear the market. I'm not saying the positive momentum won't carry through into 2025. It very well might. But some uncertainty does cloud the outlook from November 5th through January 20th. Undoubtedly, regardless of whatever obstacles emerge, the dust will settle and the long-term trends will play through. But the next 50 days could be a unique window of opportunity where the math aligns particularly well for investors who keep their eyes on the horizon.